Hey there traders, currently I'm hunkering down in preparation for tropical cyclone Alfred to hit my island on the east coast of Australia tomorrow.
Not a lot of weakening or change happening over the next 24 to 36 hours as Alfred moves closer and closer to Queensland and New South Wales, and in particular the Brisbane area.
Alfred seems like a silly name for a catastrophic weather event, but then I'm not a meteorologist, so what do I know? I am, however, a successful trader, and preparing for this storm got me thinking about how I prepare for storms in the financial markets. Nothing I'm about to say should be considered financial advice. I'm not a financial advisor. I'm not qualified to give financial advice. This is all just personal reflections from my own experience as a trader and going through that process of starting out as a bad trader, blowing accounts, and making my way up to becoming consistently profitable. So treat what I'm about to say as ideas to go out and research, not as advice. Everyone's different. Everyone has different risk tolerance and different expectations and requirements out of their trading. This is just my thoughts on these subjects. It's all well and good to talk about how to make money in the markets. Everyone wants to hear about that all day. But not many people take the time to learn about how to not lose money in the markets. So is it any wonder why 90% of aspiring traders fail? Not to me. So today I want to take a few minutes of your day to reflect with you about risk management and financial weather storm preparation planning, which I believe is the real secret to my success in the markets. When I began trading, I blew up my account several times and lost thousands of dollars. But nearly 10 years later, I'm still here, I'm still going strong, and I'm still growing. Last night, one of my systems had a record profitable night and made more money overnight than I lost in my first 2 years of trading. So I think I know a thing or two about making, and more importantly, losing money in the markets. And so here are some key things I think all traders, especially beginner or struggling traders, should understand and apply to their own trading to not only weather the storms in the markets, but come out thriving. Number 1, good education/mentorship. The mathematician and philosopher Alfred North Whitehead is quoted as saying, "The purpose of thinking is to let the ideas die instead of us dying." What he means by that statement is that a human's ability to think through a concept before acting on it allowed us to evolve as a species much more efficiently. It's much better to wonder what it might be like to jump out of a plane without a parachute than to actually try it to find out. In trading, we have education, which fulfills this purpose. Learning from a successful trader or mentor can help us avoid terrible ideas and having to learn from them the hard way, which can speed up our learning process immensely. By being subscribed to my mailing list and podcast, you're already on the right track on this front. But you can never have enough education in the markets, and learning from others is often much more efficient than learning the hard way. So seek good guidance, good information, good coaches, good mentors, and good courses. If you're new to trading, this can be very difficult to discern, and I can only recommend what I've personally experienced, so here are my recommendations. If you're a new and struggling trader, check out my coding courses to learn how to properly analyze the markets. I have a free PineScript Basics course where you can get started without investing a penny. Whether you are a fully systematic or automated trader, or even a fully discretionary click trader who isn't interested in automating your trading, it doesn't matter. The benefits are still worth the investment. Learning to code even the most basic scripts will help you understand the markets better. And no matter how you prefer to trade, there are immense benefits in having the skill of building your own tools to analyze markets and alert you of specific conditions. If you're very brand new to trading, or you're one of the many aspiring traders who discover they don't have the time or passion to learn how to trade themselves, but still want to have a more active hand in managing their investments, then I suggest you check out the Chartist's Signal service. It's the only signal service I trust and use myself to manage part of my own portfolio. It's run by Nick Raj, a fellow Australian and veteran trader who I consider a personal mentor of mine and who I've met in person several times and can confidently say he is the real deal. His signal service actually works, unlike most out there, and the strategies are easy to implement, robust, and consistently beat all benchmarks of passive investment alternatives. I've written about this service before, so check out my email newsletter on the subject and my blog post review of the Chartist if you're curious. There'll be links below in the show notes. Nick gave me a 10% discount code for anyone who signs up to their annual subscription. Again, there'll be a link to that below. So check that out if you're interested. Now, priority number 1 is position sizing when it comes to risk management. Now, I know you've all heard this one before, but there is a reason why it's touted so often in trading culture. Risk management is without a doubt the single most important aspect of profitable trading. So I need to mention it here for the beginner and struggling traders out there who haven't mastered this yet. The quickest way to make a trading system unravel and implode is to have bad position sizing models, or in other words, risking too much per trade when you lose a trade or several trades lose in a row. This is the most common method for implosion for rookie traders, speaking from experience. So if you're new to trading, start here. When I was learning to trade and having trouble making profits, the biggest change I saw to my performance came from proper position sizing. Once I began only risking 1 to 2% of my account per trade, I stopped the bleeding. It took me several months to get profitable from there, but the first requirement for profitability is to not lose all your money. The best offense is a good defense in this particular case. These days I trade a variety of different systems, and the risk management models are different for all of them. For example, in Forex, I typically risk 1% of my account balance on each trade. But in stocks, the risk is closer to 3 to 5% for some systems. But that's because these systems perform very differently in the stock market and without leverage. So there's no one-size-fits-all approach to risk management, but there is one key tenet to abide by. Do not risk more than you can comfortably lose. Not just on a single trade, but across time too. Beware of losing streaks. Know your max drawdown numbers and prepare in advance for losses. One piece of advice I have, which might be worth backtesting for your strategy, is seeing what impact reducing your position sizing relative to drawdown is. For example, if your system hits a 10% drawdown, maybe you reduce your position sizing by 25% and so on. If it hits 20%, you reduce by 50%. If it hits 30%, you reduce by 75%, etc. Change the threshold to suit your risk tolerance. This will slow the losses down at the cost of reducing the speed in which drawdowns can be recovered. But for traders who are uncomfortable with risk or new to trading, this can be an effective way to buy more time if your system goes into a particularly nasty period of losses. Now, this is not financial advice, just food for thought and something worth going out and backtesting, especially if you have a particularly volatile trading strategy. I don't personally use this technique, but I've found interesting test results with certain trading systems, and some reputable traders have used it in the past, such as the turtle traders, who systematically reduced their risk per trade for every 10% of drawdown. In any case, without first establishing good risk management, all other advice is worthless, so make sure to take it seriously. I put together a video on this subject called The Math of Winning on YouTube, and surprisingly to me, it's my best performing video with over 800,000 views as of recording this. So I highly recommend watching it if you want to better understand good risk management theory and techniques. Again, there'll be a link below in the show notes. Another useful tool in managing risk is the use of a regime filter or index filter. So for example, in the stock market, you may want to experiment with a regime filter on the universe you're trading. So for example, if you're trading the S&P 500, the 500 stocks included in that universe, then you might want to see what effect only buying stocks when the S&P 500 or SPY is trading above its 200-day moving average. So that's an objective way to gauge whether the broad market is in a bullish trend. You can filter your trades based on that regime filter. So if the market is trading below its 200-day moving average, maybe you want to tighten your stop losses if you're using a trend following sort of system. You might want to ratchet your stop loss up even tighter to lock in open profits, or you may want to close all open positions in case the market rolls over, like during the 2008 financial crisis, COVID, the 2001 dot-com bubble, etc. I've done a little bit of research with applying that to crypto, so buying altcoins when Bitcoin is trading above its 200-day moving average and so on, and a little bit with currencies, so only going long on dollar pairings when the DXY is trading above a certain moving average, things like that. And there is some promise to applying them for certain trading systems. So that's worth investigating as well. I have a video on my YouTube channel somewhere about regime filters, so go and search that if you're interested. It's also worth investigating the use of various market filters on trading setups. I've found using moving average filters on trend and momentum systems to be extremely effective, not just as a regime filter, but also as a setup filter. I've also found massive improvements to a mean reversion system of mine when I tweaked the setup ranking method to be more relaxed during bullish periods and more restrictive and selective during bearish volatility. So get creative with your conditional filters. They can improve risk-adjusted returns quite significantly in some cases when employed correctly. Next up, diversify, diversify, diversify. Once you've established good risk management into your trading approach, the next best way to reduce exposure to catastrophic risk events is to diversify your trading. There are many ways to go about this, but here are a few tips. Have a diverse portfolio. If you trade Forex, make sure to trade several major and minor pairs if possible. If you trade stocks, make sure to trade a broad market universe. For example, the S&P 500, Russell 1000, the All Ordinaries here in Australia, etc. Avoid single market systems. If the system only works on gold or SPY or Bitcoin, and that's the only place it works, then it's probably curve fitted and it's probably likely to stop working imminently in the near future. Have a mix of strategies. Don't be a one-trick pony. Don't marry yourself to trend following or mean reversion. Now, you can have a favorite style of trading. There's no problem with that. And you shouldn't trade any style that you don't believe in or believe in the edge of. But you should have a mix of multiple strategy types in your portfolio. I personally trade a trend following system, a mean reversion system, a momentum system, and some very long-term investment systems. And in Forex, I'm partial to swing trading systems. I like the 4-hour time frame, 1-hour time frame, and capturing swings in the market. So you could add swing trading in there. And I actually trade multiple variations on a few of these. Trade a mix of time frames. There's no reason to be locked in on a single time frame. Lots of traders think day trading is sexy and lucrative, and it can be, but it is also much more difficult to pull off. So don't be afraid of having some end of day, end of week, or even end of month systems in your portfolio. Systems which make trading decisions at the end of these periods. These types of systems tend to be more robust, more resilient to short-term market swings, much easier to manage than day trading, and produce very reasonable profitability comparative to the workload. So some of my systems take 10 minutes a month to manage and have made me tens of thousands of dollars over the years, which is pretty good bang for your buck in terms of workload and time, if you ask me. Even if you're an aspiring day trader, there's no good reason not to have at least a few longer term systems running in the background to diversify that risk a bit. Now, none of this is financial advice. This is just my reflections from personal experience. And finally, when it comes to diversification in trading, I recommend trading a mix of assets. So I trade stocks, Forex, crypto, commodities, or I hold bullion, gold, and I also trade ETFs. And when one sector or asset class is doing poorly, usually one of the others is making up for it, or more than making up for it. It does require quite a bit of capital to diversify across all of these aspects of your trading that I just listed. So if you're undercapitalized, then at least consider picking a few of these ideas to take to the backtesting process and research their effects on your risk-adjusted returns. There's no point diversifying if it doesn't improve your risk-adjusted returns, but I'd be very surprised if any one of these didn't. And if all of them especially didn't. And ideally, if you can do all of them, it's only beneficial to your bottom line, in my experience. And finally, good backtesting / data, or data for you Americans, or data for you Canadians. Discretionary traders may struggle with this one. It's hard to backtest a discretionary system unless it has very strict rules that allow you to analyze historical data consistently. It can be done. I've done it in the past, but it requires extreme honesty and self-awareness during the backtesting process. But even a fully discretionary trader should at least replace backtesting with forward testing, so trading the system on a demo account on live market data before putting real money at stake, and rigorous record keeping and constant analysis of their own trading data to spot patterns and potential areas for improvement, particularly on the defensive / risk management side. Now, for systematic traders, which is my specialty these days, we are blessed to have access to the highest quality market data ever available in history. So there is no good reason not to be backtesting your strategies if you know how to code. If you're a TradingView fan, then it's a no-brainer to check out my PineScript courses, particularly the Mastery course if you want to learn PineScript, and or my Indicators and Strategies course if you want to steal the source code to my best scripts If you are a stock trader, then you might prefer my Real Test Strategies course, which is a new course I put together late last year in 2024, containing some of my personal stock systems that I trade my own money with in the markets, in the stock market. So the PineScript stuff is mainly focused on Forex and a bit of crypto. The Real Test stuff is focused on portfolio-based stock market trading. So where I hold a basket of stocks, one of my systems trades up to 20 positions at a time. So that's quite different to what's possible with PineScript. You can check all that out on my website, theartoftrading.com. The Real Test course is new and still in development, and I have a few more systems I'm actively working on, which will be added to the course when I'm satisfied with the quality, performance, and robustness of those systems. I'm also working on developing a deep dive course covering general backtesting theory and some practical tools and processes for system development, both through TradingView and Real Test. So stay subscribed to my email list and podcast to be notified of when that releases, hopefully later this year, depending how the cyclone goes. Anyway, that's it for this week. Good luck in the markets. I'll speak with you in the next episode. Take care out there. Manage your risk, first and foremost. Seek good education, good mentorship, and investigate diversification methods, and make sure to have a very robust backtesting process. There are other ingredients that help with profitable trading, but those are the key ingredients in my experience that helped me become profitable. So that's where I would start. If you're new to trading, go and research those, investigate those. Not financial advice, just personal reflections from my experience over the past 10 years or so of trading. I think I'm on my 9th year trading. I've lost count. I don't really keep track of that. But it's been a long time. I've learned a lot over the years. These are the main ingredients of good trading in my experience.